And then the CPA. So this is where the accountants and the auditors step in. And so the CPA is supposed to be providing an assurance that the accounts and transactions have been presented in accordance with the accounting standards. So they're in compliance with that. The CPA or the auditor is not guaranteeing that the business is not committing fraud. So a business can commit fraud, not hide it from the accountant or hide it from the auditor, and the auditor's not responsible for that. They're supposed to try to uncover fraud and make sure the accounts are accurate. But if the business actively deceives the CPAs or the auditors, there's not much they can do about it. CPAs also offer services in terms of tax. They used to offer services on management consulting, although that business has been eliminated by Sarbanes-Oxley. So accounting firms used to be an accounting firm or audit firm, a tax accounting firm, and then also management accounting. But the management accounting was the most profitable part of the business, and that big business kind of caused the auditors to not be independent. And so, at least in the US, the regulator said if you're an accounting firm, you can't also be a management consulting firm. You have to divide them up. And so they split them off. Okay. Each state has its own board of accountancy in the US, so it's all state regulated also. In most countries, there are national boards of accountancy who regulate the whole country's accountants. US is different in that way. So US regulates accounting and insurance at the state level. Yeah.
Back to the board director, besides the minimum number of independent board members, is there any other requirement? Like in England, the board must contain at least 30% women.
A certain number of women?
Yes. Or other requirements like experience or.
Yeah. So there is no legal requirement. So there is, pressure from society or whatever to make the boards, more representative of the investors or the society as a whole. But you certainly see, especially in the technological businesses, that women certainly were very rare. And there were many businesses that had no women on their board, or most of them didn't, in the technology sector. And so that is changing. In terms of having someone who is an expert on the board, no requirement necessarily, but almost always one board member will be a lawyer. So they always have at least one lawyer there, maybe one with an accounting background, because the board also supervises the audit and the accountants, and but no legal requirement, no. And in the US, the regulator for accounting is the Financial Accounting Standards Board, also known as FASB. And they're the ones who establish GAAP, which is Generally Accepted Accounting Principles, and issue financial accounting standards, which are these FAS. So this is the US based. And the FASB or FASB does this in conjunction with the Securities Exchange Commission. Because once again, remember, the purpose of this regulation is to protect public investors or public debt holders, so public stockholders or debt holders, and give them information so they can evaluate their investment or decide on whether to buy bonds in a company. So the FASB works with the Securities Exchange Committee. So this is a industry regulatory board. The SEC also has to agree on any kind of accounting for public corporations. And so they work together and generally do not disagree, although the FASB is generally more favors regulations, whereas the SEC may not favor regulations for political or business reasons. So they tend to be more wanting a pure accounting treatment. SEC, a politically appointed board, and is very sensitive to what businesses want. And then for international accounting standards, you have the IASB, International Accounting Standards Board, and this is an association of about 120 different countries who've all come together to try to create a system of accounting regulations that will be applied globally. And so in general, this is the most number of countries use this system. It doesn't mean that they all use exactly the same rules. It's just that they base their system on international accounting standards, and then they may have certain variations, which would be the local GAAP or local accounting standards combined with international accounting standards. But this is considered the most advanced accounting system, and we'll see a little bit later. Generally, with US accounting standards, it's very rules-based. There are very definite limits. You can only do this, you can only do that, you can only have this % or so. But with international accounting standards, it's more qualitative, more judgment. So it says, what is the economic substance? You need to represent that economic substance, and you have discretion about how you do it. You just have to do what you're supposed to, but we're not going to tell you exactly how to do it. You know, so this is more general guidelines, economic substance, US, bright line rules, limits, you know, very legalistic. We talked a little bit before about the Sarbanes-Oxley Act, so this is purely for the US, and to some extent there's a lot of talk about removing many of the provisions in Sarbanes-Oxley because it imposes a regulatory burden on public companies. Sarbanes-Oxley came into being back in the early 2000s when you had big frauds in public companies. You had Enron, WorldCom, and a few other really large companies who committed huge frauds on the public, and at least in the case of Enron, did that with the cooperation of their accountant. Their accountant at that time was Arthur Andersen, and that caused Arthur Andersen to disappear just because so many people lost money on Enron. And so here, as I was saying, it prohibits public accounting companies from providing non-audit services like management accounting services, and it requires that every 5 years, whoever is the auditor from a public accounting firm has to change. So you don't develop a relationship with the company where there's too much cooperation between the company and the auditor.
Excuse me.
Yes?
What would be the reasons why US has not really fixed into the International Accounting Standard Board because they still maintain their gap. Why other European countries and other parts of the world embrace IFRS? What are the reasons?
Okay.
Will it be because the IFRS adopted by European countries and other parts of the world is because it's quantitative and judgmental, whereas US GAAP is more definitive, more explicit,
Yeah.
going by this Sarbanes-Oxley Act.
Yeah. So, you know, the bottom line is politics. And so every country has their accounting rules, and the companies and businesses in that country have adapted to those rules to maximize their reported performance, you know, profitability, you know, so they've adapted to those rules. And generally there's a lot of resistance by businesses to changing the rules. And so in the US, where the rules-making system is, you know, you've got the SEC there, which is a politically appointed board. It is very political. So whenever you want to change the rules, all the businesses will go to the SEC and say, oh, this is going to cost me money. I'm going to have, you know, lower profits reported in the past, or it's going to hurt my profits this way. this is costing too much money. They're just like, no, 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 okay? And so this is where the regulator has been captured by businesses and political interests, okay? In IAS, on the other hand, it's not one country, it's 122 countries. So it's difficult for businesses in any one country to say, well, no, we don't want it that way. I mean, they may get it that way, but generally you'll get this system with maybe some exceptions that the local businesses want, as opposed to the US, which said originally that they wanted to converge with international accounting standards, because actually the international accounting standards is a more economically sensible system. But then once the financial crisis happened and then businesses pushed back, that was the end of it. You know. So there's been a little bit of convergence, but it is unlikely that businesses will allow the changes that would be necessary to adapt to an IAS system or IFRS system. Okay?
In essence, what I can deduce is that IFRS has been largely protecting companies,
Well, no,
shareholders' interest, probably more than the US government.
or protecting shareholders, yeah, because I mean,
It's striking to me that IFRS that is being embraced by other parts of the world
yeah,
because of the larger people that embrace it. One country can easily influence the decision of changing particular line of reporting or disclosure requirements.
Yeah.
So when you compare that with GAAP, that is just solely being, for now, I wouldn't know of Canada, but at least for US.
yes.
So there's much more transparency, if I can use the word.
There is, in a way, and the other thing is that, you know, IAS has been adapted by more smaller economies, but usually bigger ones like the US has its own system. Japan, up until recently, had its own system, but is moving to IAS. China has its own system, but is kind of IAS, but has its own rules also. So, you know, it's, but this is definitely, you know, in my opinion, the best standard, the IAS standard, you know, in terms of being fair and representing performance accurately. Okay. Okay, so Sarbanes-Oxley, just generally, I already talked about how it requires the CEO and CFO to sign the paper and be legally responsible. Yeah.
How many times the audit must come and review the financials? Just at the end of the year or every quarter?
The auditor?
Yes.
Generally every quarter, because each quarter, whenever there's a legally required financial statement prepared, then the auditor has to look at it. So, and in the US, you know, a financial statement is legally required every 3 months. So the auditor has to look at that. Now, it is in the annual statement, the auditor actually says, overall, we're signing off on it, but they are looking at the quarterly statements also.
And this quarterly statement will be also in 10th July.
Yeah, that's the 10Q. Yeah. Okay. So also, if they knowingly misreport information, that's a crime. They can go to prison, so on.